Hello, everybody. Welcome to the Weekly Watch. I'm Alvaro Vivanco, the head of EM and ESG macro strategy at NatWest. John Briggs is out today, so we thought it would be a good opportunity to discuss some of the recent dynamics and our thinking about emerging markets. Joining me today, we have Eimear that's going to comment on some of the processes and the markets in Eastern Europe. But before we do that, let me just spend a couple of minutes talking about what has happened in emerging markets over the last couple of days and weeks, and what kind of factors, what kind of elements were incorporated into an analysis, given that there has been significant weakness in emerging markets, really over the course of this year. It's not something that is specific to emerging markets in general or any particular country for that matter. We really have not seen signs of any crisis. And I think for the first time in a while, it really is that developed markets, and especially what's going on in terms of tightening with the Fed and other developed market central banks, and obviously the volatility and the uncertainty that we have recently seen in European bond markets and in the UK, that is translating, that is really shocking emerging markets. That doesn't mean that necessarily it's going to be easier for them. There's still a lot that needs to be done in terms of policy. And in fact, one of the main messages that we have been sending over the last few months really is that given these external vulnerabilities, this more challenging external environment, EM central banks and policymakers, also on the fiscal side, will need to do more, will need to show greater confidence to the markets. And the only way they're really going to do that is through actions, right? So there's still a lot of hikes, for instance, that's being priced into the curve. The market is requiring higher real rates. So those rates adjusted for inflation expectations in a lot of emerging market countries are expected to go higher over the next quarters. And that's where we're seeing a lot of different reactions. We see countries that are sticking to the orthodoxy, that are doubling down, if anything, on keeping up with the Fed, on continue to hike. But we've also seen the opposite. We've seen some countries on both fronts showing a little bit of hesitancy to continue the tightening process, which is obviously very normal. It's normal because a lot of the shock to inflation came from energy prices, especially in Eastern Europe. And obviously the growth background, and we saw this last week in the IMF World Bank meetings. Essentially, the message was that growth is likely to be lower across the board, and in particular, in some cases of emerging markets, the catch up to where we were before COVID is going to take longer and longer, and really the gap, in some cases is going to be structural. So with all of this, actually over the last few days, we've seen a little bit more mixed performance of emerging market currencies. I think it's important to highlight that essentially this is a dollar strength environment. It's not necessarily that we're going to see that we have seen a lot of outflows out of EM recently. Those happened mostly last year. We really haven't seen people coming back to emerging markets and especially to local fixed income in EM. But it's basically a global phenomenon that's being driven by high inflation expectations in the US, the fact that the Fed, if anything, will have to continue on this path of higher rates for longer, and simply from interest rate differential, right? It makes the performance of emerging market currencies that much more difficult. For us, what is important, and I think even though we don't have a particularly negative scenario for emerging markets over the next quarters, what is critical for us is to see those countries that have accumulated more vulnerabilities since COVID, right? So there are a few countries in which external debt, those debts that are denominated in foreign currencies, really grew following the pandemic. And if you add the FX depreciation, it just accumulates the process and it makes it much more difficult for these countries to repay those debts. We're also been focusing a lot on the twin deficits, on the fiscal and the external account deficits. There's a big disparity between countries, and there are a few that are really more vulnerable especially obviously if we get more of a tougher environment globally into next year. So in general, we have maintained our defensive bias for EM. We still think that it's about the dollar, and we really don't see a trigger for that to happen. At the same time, I think that there are some opportunities that have been popping up in terms of valuations, in terms of places where the carry is actually quite high. The best example of that, and our preferred long EM currency at this point is Brazil, where we're going into the second round of elections in a couple of weeks. We think that that will trigger a little bit more of optimism and inflows into the country. On the opposite side, and this is something that I wanted to discuss with Eimear, are countries where again, are seeing higher debt burdens, higher or, still very elevated twin deficits into next year. Some of those examples are Philippines, Colombia, Chile, and obviously in Eastern Europe, the situation remains very, very challenging given high energy prices that hits everything, right? It hits the current account, it hits the fiscal, and it hits the need for tighter monetary policy. So let me stop here for a minute and bring Eimear into the conversation. What are you seeing as the big risk in Eastern Europe? There's been some changes in terms of how central banks are approaching the situation in different countries. Can you tell us more about it and what's your feeling?
Yeah, I think, within the C3 space, we've seen one by one that central banks have said, they can't keep hiking interest rates. They can't keep kind of enforcing these punitively high borrowing costs on the domestic economy. So they've had to shift to unconventional monetary policy. And I think it's really, their ability, the buffers they've built up in order to do this. So I think, the positive kind of poster child in all of this is the Czech Republic. So they went through kind of a 4-year period where they actually had to intervene in order to weaken their currency way back in the old days of the Eurozone debt crisis. But it meant they built up this massive pile of FX reserves. So actually, globally, they have the second highest FX reserves relative to GDP. So second only to Hong Kong, which implements a fully fledged currency peg. So you've seen them really successfully come in and basically cap the level of your Czech koruna. And they've actually been using this policy actually more aggressively. So more and more, they're kind of coming in, they're strengthening that level of the Czech koruna against the euro. And this has been relatively successful in terms of stemming that depreciation back pressure on their currency, which obviously can translate into imported inflation. I guess in Hungary, we've seen them take some very more unconventional measures. So they kind of said that 13% was enough. That is enough to deal with very high inflation in the domestic economy. And they're going to be very direct, very explicit in terms of challenging those, currency market participants who try to sell the Hungarian forint. So basically by kind of operating and pulling these liquidity levers within the economy, they have made it extortionately expensive to actually sell the currencies. They're very explicitly targeting people who want to come in and speculatively sell the currency. We did see, Hungarian forint really sell off, once they said we're, ending conventional interest rate rising cycle. So we do think it has, really depreciated significantly. And also then in the short term, these measures should act as some kind of deterrent in order to ward off those kind of speculative pressures. I think Poland is actually kind of where we're the most concerned. So as you say, we've seen kind of both the current account deficit and, the government fiscal budget deficit really kind of blowing out because of the impact of higher energy costs. And I think what's kind of most, concerning in Poland is that Poland actually is suffering not just from a natural gas kind of supply shortage, but also from a shortage of coal. Because, back in April, in complete allegiance to Ukraine, they came out and said, we're banning Russian imports of coal. Unfortunately, they did this without actually finding alternative supplies. And so now they really face the risk that they just won't have enough coal and natural gas supplies to keep their homes heated and to keep production going. On top of this, the central bank has come in and said kind of enough is enough. They can't keep hiking interest rates. and that they will do FX intervention. However, they don't really have the reserves to do this in enough scale for markets to credibly believe that. We're also coming into an election year in Poland, and the government has come out with quite an ambitious fiscal budget. So we think they risk a little bit of, perhaps what we saw in the UK, where you could see markets really questioning the feasibility of their fiscal stance in the context of the significant both fiscal and current account deficits. So we're probably most bearish on Poland. And at the opposite side of the scale, we think Czech Republic just kind of stands out, and it's probably, that great example of what EM central banks will have to do in future in terms of building up significant reserves so that they can, defensively support their currencies if we ever get an environment like this again.
Yeah, no, that's interesting. And clearly the market has been on top of policymakers, right? We only have a few cases where they have been able to manage that transition towards stopping the hiking cycle, only when inflation expectations have really converged quite a bit, as it has been the case in Brazil. But the other central bank that I guess is taking more of an orthodox, slightly more hawkish stance is South Africa. Do you think that's a game changer for the rand?
Yeah, I really think it stands the credibility of the South African Reserve Bank. They don't actually have the same problem as the rest of the world. If you look at inflation in South Africa, I think it's about 7.6%. So kind of relative to the global peers, they're actually doing very well. I think a lot of that is to do with kind of idiosyncrasies within the domestic economy. But what's been really pertinent is that the Central Bank of South Africa have come out and basically said that they will keep hiking in line with the Fed. And that is very much focused on kind of maintaining the confidence of markets, maintaining, foreign funding for their debt burden, foreign funding for their fiscal deficit. And they have done that relatively successfully. So since they started tracking the Federal Reserve, we've seen kind of foreign outflows really slow off in terms of their sovereign bond market. And we think basically all we're waiting for now is a Fed pivot, because essentially, once we get kind of some kind of easing off of this dollar bull run, South Africa is well placed. They're offering investors significant, carry pickup, positive real rates, which is very hard to come by, in these markets. And their economy is actually doing relatively well. They're kind of bumbling along. And actually their fiscal position has actually improved and is much better than what we thought kind of going into the COVID situation.
Yeah, thank you. No, I think that's very important, right? That you are seeing countries doing the right thing, and it's gonna take some time to see the benefits of that materializing just because of the dollar environment. But in terms of vulnerabilities and the market reaction, we are already seeing quite a bit of differentiation. Let me just bring it back to Latam for a minute before we close. And there's been a lot of questions over the last couple of days on Colombia. We have been on the negative side. I think that this is a country where you're seeing a steady deterioration, exactly along the lines that we have been talking today, right? Central bank is not doing enough. It's hiking, but it's not hiking as much as needed. The new government is underlying, the right kind of path at this point, being a little bit, not necessarily overtly more aggressive in terms of fiscal, but not willing to adjust at the margin. I think all of that under this external environment becomes very, very dangerous, right? Where the market is going to penalize the ones that are not doing the right thing. So for Colombia, even at these levels, we continue to be very, very defensive. I think on a structural level, this is one of the places that again has very high twin account, current account, and fiscal. We're not seeing the right messages from the policymaker, and is not going to change the environment, anytime soon. Thank you for listening. If you like this episode, please subscribe to our channel to get the latest one as soon as they are available. Have a good week.